Welcome to TMS Insights, the July edition. Ben Clark and Jeremy Hook bringing you some news in the market, what's been happening. Well, it's all been about Greece and also China, Ben, in the last month since we last updated everybody. And again, we're probably breathing a little easier on both fronts at the moment, but it's been a really rocky ride.
Frustrating, right, I reckon. You know, the Greece deal just kept getting pushed out a week and then another week. I think we were of the view that although these were concerning sort of developments overseas, they were also developments that would get resolved, although the Chinese share market's a harder one to work out. And subsequently, we've seen that happen, seen a bit of a relief rally in the market, and coming into earnings season, we'll see hopefully attention focus more on fundamentals rather than these big sort of macro events that are pretty much impossible to sort of predict in terms of how they're going to play out and in what time they're going to play out. Yeah,
definitely. They do toss sentiment around a lot, but like Ben mentioned, we're a lot happier getting back home and talking about stocks individually.
Yeah.
And on that front, I guess one of the big areas of recent news in the market has been about the banks, and in particular APRA, the regulators' requirements the banks hold more capital. They've come at this a couple of times, Ben, but it looks like we're going to be seeing banks, in addition to previous raising about another $12 billion across the big four, which will have a bit of an impact.
Definitely. I mean, we saw NAB did the largest capital raising in Australian corporate history only a couple of months ago. And as that occurred, not only did NAB share price come under obvious pressure, but so did the other three, which were used as funding vehicles to take up a really well-priced rights issue from the bank. And of course, the three of the major banks don't report in this earnings season, but CommBank does. Ian Narev has been pretty resilient, saying we don't need to raise capital, but I think that's now looking like a sort of a less sustainable position, and a raising is likely. And I think if you are looking to get money into the banks, it's probably through the raisings now, as opposed to having to buy shares on market, because most of them we feel still are come raising. And it probably also means, I believe, that dividend growth in the banks over the next couple of years is not going to be what it has. I mean, it makes no sense to be paying more of your capital back to your shareholders if you know that you need to raise more capital down the track.
Yeah, and just to clarify that point, it probably doesn't mean the dividends are going to fall in any way, but they're not going to grow. And we've been very used to dividend growth from banks over many years, but the immediate outlook is probably for zero growth in the dividends. Still, though, they are very attractive as income stocks, and yet without that dividend growth, it might actually bring a lack of share price growth. So a bit of up and down action, trading style of positioning, but it means you don't necessarily want to be way overweight in that space.
Yeah, I mean, there's always this arm wrestle, isn't there? I mean, you can buy NAB at the moment and still nearly get a 9% gross dividend yield, which there's very few other stocks that offer such a great income return. But on the flip side, there's probably over the medium term, I agree. I think the banks might be in a trading range for a while yet, and they're probably at sort of fair value at the moment. They could still push up a bit from here, but we don't see the run that they've had over the last few years, I think, continuing into the next few years would be probably fair to say, wouldn't it?
Yeah, I think so, yeah. Talking a few stocks individually, last time we did an Insights, we mentioned a couple of companies that had either fallen a little low, maybe for a profit report, that was highlighted to be a little less attractive than previously thought. Things like a Seek, for example, or a Flight Centre, and they've certainly improved and moved along. One that's done quite well, we mentioned around the same time as being a bit cheap, was REA.
Yeah, it's been great to see. I mean, the stock's traded back up to around $44. So it's been quite a strong bounce. And, I think one thing, I always try to say to clients is, these sort of weaker, more volatile markets, they can certainly, from when they're macro concerns, they can throw up great opportunities from a stock point of view. REA has its obvious issues, as we identified in the last video we did, but it's been great to see that company well and truly bouncing back in terms of share price.
Yeah, and we have through the market had a couple of companies give some warnings over the last few weeks, nothing of massive size, but one specific company that had a big announcement. We do hold quite a bit through the client portfolios in Duet.
Yep.
That they're making a bid for energy developments, and they're also doing a large capital raising to fund part of that.
Yeah, and it's a big deal. $1.9 billion takeover it's not insignificant given the size of Duet. I think there's some respects they're doing this so that Spark can't have a crack at them, who have been acquiring shares in Duet during this period of market weakness. But the analysts seem to be pretty optimistic on the deal, and certainly Investors Mutual, who are a big shareholder in Energy Developments and Duet, have given it their tick of approval. Who are conservative managers of money. The rights issue price of 202 looks very attractive.
So the yield there would be about 8.9%,
which again is very hard to come by in the market. So we'll certainly be recommending clients take that up. I
and
think.
looking at that when that comes back on the market.
Yep, another day or so in a trading halt, and we'll then see how the market's reaction is. But the demand for these long life infrastructure assets remains very strong, as we've seen in other companies that we own in portfolios.
Yeah, exactly. And just looking ahead for a moment, August brings about reporting season for most June 30 companies, so that'll be a very busy time for us. We're going to get across a lot of companies through presentations, meetings and the like, Ben. Expectations, I mean, we've been, I guess, progressively led a little bit lower on our guidance, but it'll be an okay season.
Yeah, look, I've been doing a bit of work on coming into the earnings season, and a couple of comments I'd make that, sort of sometimes the press can be a bit overly negative, is that we've actually had the smallest number of profit downgrades coming into this earnings season since the GFC. So that's an optimistic thing. On the flip side, we've had the smallest number of profit upgrades coming into this earnings season than the GFC. So I think one thing that alludes to is companies have become much more much more conservative, but much more
cautious
vague,
on guidance.
guidance. And so it's harder for them to miss or to exceed it. The other thing is, which I think you said there, which is right, is that earnings forecasts have been high at the start of most years, and they've gradually come off, and that's happened again this year. I don't think that most managers have got particularly high hopes of this earnings season, so I think most companies should be able to deliver. And a lot of the real share price movement will come down to the outlook statements as opposed to what's happened, I believe. So, what's going to happen FY16. So I think there is hope at some stage we start to see some revenue growth, which kicks off profit growth as the economy transitions.
Yeah, no, there's a fair bit to do. And again, I think don't buy into that slight pessimism that you get fed from the media. It'll be reasonably good, and we're quite confident across portfolios. But we'll be watching stocks very closely, and we'll be bringing you that news through that reporting season. That's all we've got time for today. We'll be bringing you that next one in August during reporting season.